Morning everyone, welcome to Ainsley News. It's Monday, 14th of February. Happy Valentine's Day for those celebrating. Today we're talking the Minsky Moment meets war and inflation. The drums of war are sounding louder than ever, and on Friday's night confirmation that Russia is to invade Ukraine this week, both gold and silver nearly surged 2 to 2.5%, while shares fell around the same. But this comes at exactly the time the market is worried about an extraordinary meeting to be called by the Fed to bring forward rate hikes adds to instability facing them right now. Lance Roberts of Real Investment Advice penned the article we're going to talk about today before that announcement, but the relevance is now even greater. The market is a bubble looking for a pin, and there are no shortages of those pins. A little longer than usual today, but definitely worth listening to, and includes some incredible charts, so do jump over to our website to check out those in more detail. This time is different. The Fed's next Minsky Moment. Those are the words of or usually uttered at the time of peak bull markets throughout history for stock market investors. However, this time is likely different when it comes to the Fed and their current view of aggressive tightening monetary policy. To understand why this time is different for the Fed, we also need to know why the next Minsky Moment almost certainly awaits them. So what exactly is a Minsky Moment? Economist Hyman Minsky argued that the economic cycle is driven more by surges in the banking system and credit supply than by the traditionally thought about critical relationship between companies and workers in the labour market. In other words, during periods of bullish speculation, if they last long enough, the excesses generated by reckless speculative activity will eventually lead to a crisis. Of course, the longer the speculation occurs, the more severe the crisis. Hyman Minsky argued that there is inherent instability in financial markets. He postulated that an abnormally long bullish economic growth cycle would spur an asymmetric rise in market speculation, eventually resulting in market instability and collapse. A Minsky Moment crisis follows a prolonged period of bullish speculation, which is associated with high amounts of debt taken on both retail and institutional investors. One way to look at leverage as it relates to the financial markets is through margin debt. In periods of high speculation, investors are likely to be high leverage or borrow money to invest, which leaves them with negative cash balances. This time is different. Understanding what a Minsky Moment is makes it easy to understand why this time it's different for the Fed as they approach their current monetary policy tightening cycle. Since 1980, each time the Fed tightened monetary policy by hiking rates, inflation remained well contained. Show a few charts today. They show the Fed funds rate compared to the Consumer Price Index, or CPI, as a proxy for inflation. There's three essential points in these charts. The Fed tends to hike rates along with inflation to the point that it breaks something in the market. For the majority of the 30 years, the Fed has operated with inflation averaging well below 3%. The current spread between inflation and the Fed funds rates is the largest on record. Historically, the Fed hiked rates to combat inflation by slowing economic growth. However, this time the Fed is hiking rates after short-term fiscal stimulus pulled forward demand, creating inflationary pressures and a surge in wages. Combined with already high levels of leverage, an aggressive rate campaign is precisely the catalyst needed to ignite instability. The Fed will have to choose. In 2010, Ben Bernanke launched quantitative easing to lift asset prices, increasing consumer confidence. And while that worked previously, it isn't working now. More importantly, Jerome Powell and two other Fed members are heavily hinting at more aggressive policy. Bostic says Fed could easily pull $1.5 trillion of excess liquidity from financial systems, then watch market reaction for further balance sheet reductions. From Mester, able to let the balance sheet run down faster than last time, Powell, we expect to allow balance sheet runoff later in 2022, and from Powell, balance sheet is far above where it needs to be. The problem with such more aggressive campaigning, as Hyman Minsky alludes, is the potential unwinding of that leverage. Such has historically had poor outcomes. As we've previously noted, the Fed didn't have inflation during successive rounds of monetary interventions. Trillions in bond buying programs did inflate asset prices, not to mention wealth inequality. However, QE didn't translate into surging price inflation. Such was because the Fed's monetary interventions remained contained in the financial markets rather than leaking into the general economy. Today, however, it's a very different story, and the Fed's biggest problem is maintaining stability. The Fed's ongoing interventions have created a moral hazard in the markets by inducing investors to believe that they have an insurance policy against loss, Therefore, investors are willing to take on increasing levels of financial risk, as shown by yields of CCC rated bonds. These are corporate bonds just one notch above default or defaulting, and should carry very high yields to compensate for that default risk. As noted, with the entirety of the financial ecosystem more heavily leveraged than ever, the instability of stability is now the most significant risk. The Fed must now choose between supporting asset prices and maintaining stability or combating inflation. So unfortunately, it's a lose-lose proposition. The outcome will be the same. While the Fed is currently hopeful that economic growth will remain strong in 2022, they are likely to be very disappointed once again. Given the economic surge was a function of temporary liquidity, the expansion will also be just as transient. Savings rates and disposable incomes already show early signs of reversion. Unwittingly, the Fed has now become codependent on the markets. If they acknowledge the risk of weaker economic growth, the subsequent market sell-off would dampen consumer confidence and push economic growth rates even lower. If they ignore inflation to keep asset prices elevated, inflation will eat into the consumer's ability to sustain their standard of living. In turn, consumption will slow and the economy will slide into a recession. The Fed has a tough challenge ahead of them with very few options. While increasing interest rates may not initially impact asset prices of the economy, it's a far different story to suggest that they won't. There have been absolutely 0 times in history the Fed Reserve began an interest rate hiking campaign that did not eventually lead to a negative outcome. The Fed is now beginning to reduce accommodation at precisely the wrong time. Growing economic ambiguities in the US and abroad, peak autos, peak housing, and peak GDP. Excessive valuations that exceed earnings growth expectations. The failure of fiscal policy to trickle down. Geopolitical risks. Declining yield curves amid slowing economic growth. Record levels of private and public debt. Exceptionally low junk yield from bonds. Such are the ingredients that are essential for the next Minsky moment. When will it be? We don't exactly know. What we do know is the Fed is going to make a policy mistake, as this time is different. Unfortunately, the outcome definitely won't be different. And thanks for joining us for news today. Jump over to anzbullion.com.au if you're looking to buy gold, silver and platinum. You can also check out places to sell. And sneakily, you can also exchange into cryptocurrency if you think this is a great time to do that. Also a reminder that all of our news is written down and has all of its images, charts, graphics, graphs, all that through the website as well in the news section. ainsleywealth.com.au for everything cryptocurrency. Check out our dashboard in there and you can get some amazing insight into the analytics of crypto. Just click on that dashboard icon and you can find out more. Or goldsilverstandard.com. That's our own crypto that we've backed and built at Ainsley, pegged to real gold and real silver, stored at Reserve Vault and Melbourne Vault. Enjoy your Monday, everyone. We'll catch you tomorrow for more news.